Hi, I'm Peter Rose, founder of Longwood Currency Trading. Should you trade more than once a day? Maybe. The story that I tell and experience in folks that I know who go skiing is they always say, when you feel like it's the last run of the day, well, don't take that run because you're probably going to have an accident. How do you know when the last run of the day is going to be? Well, it's kind of like you have a feeling, oh, I just need to get one more in. It's that different feeling that tells you maybe I've had enough. And I think in trading, it should be the same thing. I don't think there should be a carte blanche rule that says you take one trade a day and that's all there is, because if you try to get one more, you're too greedy, or your chances, your probabilities of failure go up. I disagree with that, because the probability analysis doesn't indicate that at all. I think your probabilities are the same. You're a 50-50, or if you're a 60-40 trader, it's 60-40. It's whatever that metric is. When I do my simulation analysis in my trading, I work that into consideration. I go in and I fail the trade at a certain point. I come back and I go back in if it reaches there, and I keep trying it again, because each time I go into trade, I'm still 60-40, 70-30, or whatever my particular win-to-loss ratio is. And I can work out the mathematics that says what's going to happen. Usually when I run my simulations, I don't run them against my metrics. I run them against, I think, reasonable metrics of 60-40. You win 6 times for every 4 that you lose, or 60 times for every 40 that you lose, to develop a sense of how you're doing on a transactional basis from a decision-making standpoint. And so at each time when you do your entry analysis, there's you can lose money on your entry stop, or if the price moves up and you don't move your stop, you can still lose, or whatever. So I think that's where your analysis, your post-trade analysis comes in. Where are you losing your money? Are you losing it all on the entry stop, or are you taking a position that moves in profit? How far does it move in profit before it turns around and goes against you and takes you out? Is that 5 pips it takes you out after you've gone 5 pips up, and then it turns around and goes to 10 or 20 pips to hit your stop, which is at 10 pips or 20 pips or wherever you're going to hit the stop. When you're trying to develop your metrics, you're trying to develop a sense for how you're trading. And so once you start compounding, once you start staging or reverse staging, or going into a build stage scenario that I've talked about before, the win-to-loss ratio really doesn't come into effect on a positional basis. It's still important to you because it tells you how good of a trader you are as a whole under an all-in, all-out scenario. The mathematics, if you trade more than once a day, can screw things up unless you're analyzing that on a per trade basis as opposed to a daily basis. Once you get experienced in your trading, you don't really care what goes on a transactional type basis, whether you're trading once a day or 5 times a day, 100 times a day. It doesn't make any difference, because at the transactional level that metric doesn't apply. You say that on a daily basis, I have a daily win-to-loss basis, which is like looking at price action through the lens of, say, a 55 period moving average, as opposed to maybe when you're actually trading, you're looking at it through the lens of an 8 period moving average. And remember, my comments come from the standpoint of a day trader, primarily a day trader, down on the 5-minute chart with an ATR of 5 pips. You always have to keep that in mind as you listen to my videos, because I'm basing everything on that structure. I'm entering with the intent to be out and flat at the end of the day. There's no stipulations to how many trades I want to take in a day or what goals I have. That's not part of it. I'm a day trader. I'm going to trade during the day, and I'm going to be flat at the end of the day. And for me, I'm trying to specifically orient my trading to about a 2-hour time frame within that day trade scenario. I don't want to be sitting at my computer trading for 6 hours. I don't even want to be there for 2 hours. I don't want to just be a machine gun shooting bullets around hoping that I'll hit something. I'm more wanting to be a sniper. I want to do my entry analysis. If it doesn't meet up to my criteria, and there's simple criteria, there's 3 criteria with a 4th one that I throw in, but that takes a lot of experience in order to, if I'm going to talk to somebody about that, they need a lot more experience with how I trade in order to understand that. I want to make things very simple, and so most of the time I'm going to be 1 or 2 positions a day in about a 2-hour time frame. Most of that is after using what I call my entry analysis process. Each time I make that trade, I just don't make a trade and then get out and then, oh, it flipped around, it's going the other way, it's going in my direction. Okay, I'm going to go back in again. I have to go through that whole entry analysis stage. That's why it has to be simple, so that it can be done quickly and I can make that determination whether the risk is there or not. Because as soon as you enter the trade, regardless of what you've projected over the next 15 minutes or 2 hours, your probability that the trade is going to move in your direction might be 70% because you got a 30 win-to-loss ratio, and so you figure you're 70% in the right. You may be correct in that in a long-term frame, but you're not doing a long-term frame when you make that position, when you enter that trade. Because as soon as you enter that trade, it's 50-50 jump ball whether the next tick is going to be up or whether it's going to be down. And the variability of it is, if it goes down, for example, if you're going long, if price goes down against you, that's that 50-50. But the next consideration is, if it goes against me, how far is it going to go against me? On a 5-period ATR, that could be a 5 or 6 pip move, boom, just like that. I was in a trade position the other day, watching it, and it went 30 pips against me in about 10 seconds. So there's that variability. So you have to understand the probabilities of the ATR of the price pair that you're looking at, so that you can evaluate your risk and say, okay, in the long run, I think this thing could go up this far. But where is surrounding structure standing such that if price moves against me, are there any factors that would cause that price to break a normal ATR? Because I'm trying to keep about a 10 pip stop, and it's very difficult to make the decision to go into a trade based on knowing that you've only got 10 pips of breathing room. So if you don't really get that right, then you're going to hit that stop more than a 40% of the time, and maybe 50 or 60% of the time you're going to hit that stop. And I've told people that kind of chat with me through emails about this stuff is, yes, my stops tend to be very, very tight at 8 or 10 pips, because if I'm wrong, I want to get out right away and lose the least amount that I can possibly lose. And I don't want to stage into a loser, because that takes time. The reason I don't want to stage into a loser in the hopes that we'll go back up because I'm averaging the losses to a normal loss that I would be willing to take anyway, is the fact that if I'm trading multiple lots, let's say I've got a 5-lot capable bank, and so I go in with 5 lots in the beginning and I take a 10 pip hit, I'm $50 out, right? So I'm sorry, 5 lots, it's $500 hit, right? I go in with 5 fulls, I take a 10 pip loss, and I lose $500. Well, if I go in with 1 lot and then add 1 as it goes against me, then the average between where I go in and where I stage to that 10 pips, the average loss then becomes maybe 3 pips or 8 pips or whatever that's going to be. If you do it on a straight average over 10 pips, you're going to be 5. Okay, just because that's the way you're going to be going in. So that if you lose $50 a pip times 5 pips, you lose $250 instead of $500. So that's managing your risk that way. On the other side of the coin, if you go in with that 1 lot to stage into the position if it goes against you, but also to stage in if it goes up, if you're looking for a 10 pip profit target to get out, the same way you got out with your loss, well, what happens then? Now what are you going to do? You're going to stage in 5 lots. Where? Within that 10 pips. So you're at 5 pips on the 5, so you make $250. Where the intent would be, well, I could risk to lose 10 pips on $50 a pip, or I could win 10 pips on $50 a pip. And if I'm a better than 50-50 trader, net over 10 trades, 100 trades, or whatever it is, I'm going to come out okay. This is the mathematics of trading. And it factors into those decision processes. So what screws that up is that if you're learning to trade and you're developing your ratios, you really don't know what kind of a trader you are if you're doing all these mechanical things. And so every now and then in my trading, I'll drop back in size and I'll just trade all in, all out. And try to get a sense for how many times is that 1 lot or 3 lot or whatever I'm experimenting with, how many times is that getting hit, and how many times am I going to my profit target. And as I've said many times before, once stuff starts moving toward my profit target, I take this limit stop off because I don't want it to choke my trade. If that trade continues to go on, I'll grab 20 pips or 30 pips if I can get them. I'll go into a carry trade and carry it for days if it's going to go in my direction that far. Unfortunately, the way I trade, most of my stuff just bombs out at going higher because I have such strict risk management guidelines that any type of a reversal and I'm out. So I miss those continuation movements. I know what my win-to-loss ratio is, and if I can win just a little bit more than my average win value, then I'm good with that over the long term because I'm trading for the long term. And what that gives me and provides for me is the ability to build up a fairly substantial bank so that when I want to swing for the fence, I can do that and risk the loss of a large amount of money because it doesn't chew through all of the money that I made. And those risk events where you swing for the fence don't come up very often. So you've got plenty of time to build up plenty of bank, and the amount of risk that you're going to take when you lose is proportional all the way through, so that if I built up a lot of earnings, then the hit that I take is very small against that group earnings. Last year, 2020, I took a $20,000 hit, It was a mistake. I had left an order on, but I didn't mean to. But I had already made $70,000 or $80,000. So taking that 20 loss, yeah, it's $20,000, but it didn't impact the 70 that I had already made to that extent. It took 20 pips off the 70, and I still had $50,000 left, which is the ability to go in my world where you trade a lot for 10,000. I got 5 more lots that I can trade. And so then I go back in, I'm trading with maybe 10. Now I've got this extra 5. I've lost 20,000, so I've lost the ability to trade 2 lots. I still have 5. I go in, maybe the next trade, I'm trading 15 lots, and I more than make up for that. That's how you do your risk management and balance it. I don't know what all these guys are doing, talking about how they manage their risk management. It's more intricate than just saying, well, I'm going to do that today because things look good, and I'm going to get out now because whatever, or I'm going to set my stop at X level. This is all about your trading plan. The critical thing that I would share with you would be, you first of all have to know some trading metrics. How are you as a trader, as an all-in, all-out trader? You can do that when you're learning at using a mini lot, but it doesn't really make any difference what value you're working on. What makes the difference is to trade until you learn to get consistently profitable, and then as you're trading and you're consistently profitable, trade for another 30 or 40 trades that way, so that you're testing what your trading metrics are over a trading sample size that's a good trading sample size. And then you can say, oh, I've got confidence in my trading ability because even if XYZ happens, for example, the statistical likelihood that you're going to have 6 losing trades in a row. What happens if that's when you're starting out the month and you lose 6 losses in a row? Now you're really underwater for that whole month. If you're trying to judge, well, this month I made 4% on my money or 40% on my money or whatever I'm doing, that kind of throws that all out of balance. Instead of having the difference between having 6 winners in a row at the beginning of the month and then doing your normal 6 losses in a row after that, and you've had time to build up, and so it enables you to then look at your trading on a daily basis, on a monthly basis, and then you can say, oh, I'm going to sit down to trade, and if I trade with X size bank, I can expect to have X% return against that bank. I had X% return against a $20,000 bank last year, and a 40% return against a $20,000 bank. I made $8,000. Okay, so now I'm trading a $100,000 account, so now I'm going to make $40,000 on that because I'm consistent in my trading. So, should you trade more than 1 time a day? Probably not, until you get some good statistics behind you. And then, once you have those statistics, now you're dealing with more information and you're capable of making the decision, do I want to take that next trade? And the only thing that next trade should be based on is 2 things. Number 1, does it meet the entry analysis criteria for taking a trade that you would always use, or are you don't want to just say, well, I won this last trade, so I'll go into the next one because I'll win that one because my probabilities are high. No, they're no higher than flipping a coin. It's 50-50. So don't get your bowels fired up over something that really isn't there from a probabilistic standpoint. Don't let that cloud you. So make sure everything has got that same entry criteria that you need it to have. And also make sure that you're not trading or making that trade because it'll be the last one that you make for the day. If you think that, oh, I'll just take this one more trade and then I'll be done for the day because I will have made 1.5 times more money than I made on the first trade. Don't take that trade then. Then I would advise against that. But if you don't feel that way, if you've got good confidence in yourself and you're early in the day of the market, and you've got time to spend there, remember, you're going to need it, if you're doing it the way that I do it, you need at least 2 hours, because you may have to sit there for a half an hour or an hour in order to see what's going on with your trade. I'd say probably 60 or 70% of the trades that I do either come to a win or a loss within 15 minutes, 20 minutes. So if I have to sit there and look at, oh, okay, it looks like something's going on here, I'll sit here, oh, okay, and after 15 minutes, here's the trade that I want to make, I'm going in, and then you set that order, and then it takes another 5 minutes or 10 minutes for the thing to get there, boom, the order hits. So I'm 20, 25, 30 minutes, 35 minutes into the trade, take another 15 minutes, I'm an hour and a half, hour and a quarter into the position to close it out. So that's what I'm doing. So if I've spent an hour or 45 minutes on that first trade, and I'm trying to get done by the end of the day, I'm done. I'm not going to take that second trade unless I've got real high volatility momentum, and I just go in with a big load. I'll go in with 6 or 8 lots, and I'll take 3 or 4 pips, and I'm gone. 4 pips at $80 a pip, that's $320. But people don't make $150 a day, and if I can scalp that, that's great. But I'm not going to sit there going through this full entry analysis and say, okay, I'm in there for the 10 pip run or the 20 pip run, whatever it is, because that's taking that last ski run for the day. So you don't want to do that. I hope that was helpful for you. In any event, don't take that last run of the day by making that additional trade. However, if it's not the last run of the day, take 2, 3, 4, 6, 8. It doesn't make any difference, because the probabilities are going to be the same for you if you know what your trading metrics are. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.